Coming up on Market to Market, agriculture takes a deep breath as Trump steps on a dragon's tail. Ethanol producers continue to fight for farmers and market share, and a closer look at one group of growers NAFTA left behind. Those stories and market analysis with Naomi Blohm next.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, March 23 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. The world is watching as the #1 and #2 world economies square off. The U.S. took steps this week to reduce the biggest trade deficit in history. Apprehension over a looming trade war with China will build over the next 60 days as both sides maneuver for leverage. It remains to be seen if China will retaliate with 25% tariffs on a long list of U.S. agricultural goods. Peter Tubbs has the details.
We have one particular problem, and I view them as a friend. I have tremendous respect for President Xi. We have a great relationship.
Despite the kind words, President Trump signed a memorandum aimed at cutting the $500 billion trade deficit with China by levying $50 billion in tariffs.
This is the first of many. This is #1, but this is the first of many.
Many had advised against the move in fear of starting a trade war that would touch everyone from farmhouse to high-rise. Chinese officials were quick to respond with a list of 128 potential U.S. products that might be subject to tariffs, including pork, apples, and modified ethanol. Opening salvos had already been fired by China on rumors alone. Last month, an anti-dumping probe was launched on U.S. sorghum imports, and this week, a state-run newspaper accused American soybean farmers of an unfair advantage in Chinese markets. Kansas Senator Pat Roberts, a Republican, wondered if a special payment would be needed for farmers hit financially by Chinese tariffs.
We're in a dire fix. We're trying to write a farm bill here, and it's with a backdrop of severe budget limitations, and we know that we have to do that. But if we have to go down the road with a special payment with regards to retaliation, that just adds another dust-up right before the farm bill. This is not a good situation.
Officials with the National Farmers Union said retaliation for the new tariffs would hit family farmers and ranchers first. The American Soybean Association released a statement saying U.S. soybeans were squarely in Chinese sights. The Dow Jones Industrial Average plunged more than 700 points, and the Nikkei plummeted 3% on the news as investors searched for safe havens. From Market to Market, I'm Peter Tubbs.
A domestic battle is being waged over renewable fuels. Ethanol continues to fight with big oil for a bigger piece of the energy pie. The most recent skirmish has both sides pressuring the White House to broker a deal. Paul Yeager reports.
The current proposal places a cap on the price of certificates oil refiners must purchase if they are unable to blend biofuels. For gasoline producers, the certificates, known as RINs, are proof a gallon of ethanol was purchased for blending. RINs are traded on the open market and can fluctuate in price. In exchange for the price cap, the biofuels industry would be allowed to offer blends of 15% ethanol or E15 year-round. President Trump summoned all parties concerned to the Oval Office to hammer out a deal. Jeff Broin, chairman and CEO of POET, the nation's largest producer of ethanol, was among those invited.
In that meeting, the president was very clear that he wanted to see E15 nationwide, which is a big positive for biofuels and agriculture. but he also was clear that the oil industry wanted some RIN relief.
Royne believes opening the market to E15 will be an incentive for the biofuels industry to expand. The expansion would increase the amount of ethanol available and, along with it, the number of RINs. So far, the oil industry is holding its ground. EPA Administrator Scott Pruitt has stated his agency could solve the problem, but he has yet to come back with a solution. This week, Secretary of Agriculture Sonny Perdue suggested Congress should handle the issue.
You know, I think that this has great momentum. I think handing this over to Congress would slow things back down.
Iowa Senator Charles Grassley wants to keep Capitol Hill out of the equation.
I think those changes would be bad because I think if something ain't broke, don't fix it.
Royne believes the situation is on the fast track to resolution.
I believe he thinks it's important for both merchant refiners and all of Middle America, who is very important to him in the election.
For Market to Market, I'm Paul Yeager.
The North American Free Trade Agreement is another deal with an unknown fate that extends beyond rural America. An eighth and possibly final round of talks is planned for Washington, D.C. in April. The landmark trade pact has its fans, but there is at least one agricultural sector of the economy that was left behind. Josh Bittner has our cover story.
Not being fair with us. This is our opportunity to provide an impetus to freedom and democracy in Latin America and create new jobs for America as well. It's a good deal, and we ought to take it. Thank you.
With those words and the stroke of a pen, President Bill Clinton signed the North American Free Trade Agreement, known as NAFTA, into law nearly 25 years ago. The treaty created a $6 billion marketplace that served the 360 million people living in the United States, Canada, and Mexico at the time. Proponents hailed NAFTA as a boost for the U.S. economy, but critics warned of domestic job losses, among them Florida's winter vegetable growers.
Since that year, we have deteriorated down to probably about a third to 40% of the size that we used to be because of the trade agreement, the free trade agreement, NAFTA.
Market to Market spoke with Paul DeMare, one of the Sunshine State's top tomato producers, in 1998, a few years after the trade pact was ratified. Before Congress, DeMare forecast the deal would cede market share to Mexico, citing meager wages, poor environmental regulations, and lax enforcement of child labor laws.
He testified back in the early 90s about what NAFTA would do to the state of Florida if it was passed. They didn't listen to him. It's way worse than what he ever described.
Kern Carpenter is a third-generation tomato grower in Homestead, Florida. He's watched the acres planted across Miami-Dade County dwindle from tens of thousands in the early 1980s down to around 1,000 today, leaving just a handful of producers. Situated atop the abundant Biscayne Aquifer, South Florida is a traditional supplier of winter fruits and vegetables. Area growers agree they are incapable of satisfying all domestic demand, but Carpenter says NAFTA destroyed his upper hand by flooding the market with cheap produce. And he says the result is easy to spot in grocery store aisles.
Last year was the worst year of all the years that I farmed. The price averaged like $6 a box throughout the whole year. It takes about $10 average to break even, so it was a total disaster.
Carpenter hung on, though, driven by the outcome of 2016's presidential election.
NAFTA has been a horrible deal for the United States. It's been very good for Canada, it's been very good for Mexico, but it's been horrible for the United States.
I was thrilled to death when Trump became president because he's the only one that really was smart enough to see that we have a huge problem and something needs to be done. And he seems to be at least trying to attempt to do something about it.
For countless Americans, this agreement has failed.
But NAFTA renegotiations have been complicated. Midwestern row crop farmers largely support the deal, as is, for quadrupling farm trade and boosting exports of grain and oil seeds.
I feel like we're forgotten. No offense to the growers out west. I have friends that are out there, but a lot of that's subsidized by the government. They farm 30, 40,000 acres. That's a huge farm. And they do it with 6 guys. On our farm, we have between 60 and 80 people at any given day working every day, harvesting crops.
Tommy Vick also grows tomatoes in Homestead, but he's diversified his 900 acres of perishables to target niche markets and hedge against cheaper imports.
You don't know what the market's going to do, but if I've got 28 different crops, if I don't make it on one of them, at least half of them are going to make something.
Vick may be ahead of the curve, but he believes Mexico can still cut into his bread and butter.
Bottom line, to pay somebody $2 a day to work, you know, even though it's a third world country, you know, that's not fair. What would be an ideal situation? It's hard to say.
Quotas and tariffs have been floated, but as both sides continue to search for remedies, Vick and others say NAFTA also has unintentionally increased smuggling opportunities.
If they send a load of tomatoes, but you've got $2 million worth of drugs in there, who cares if they use the tomatoes or don't use the tomatoes? So that in turn gets dumped on the market and affects us also. Peppers and...
But illegal trade practices like currency manipulation and predatory pricing remain a top concern for some U.S. farm groups and local government.
What they're looking at now is the ability to seasonally bring the anti-dumping suits, which Mexico has said is a non-starter, which right there tells you that they're dumping seasonally.
Miami-Dade County Agricultural Manager Charles LaPrade says farm sales in his area average $700 million annually. But under the current system, half the growers of any commodity have to sign on to anti-dumping litigation, which he says costs nearly $1 million per case.
Our window is such that they know they can hammer us between January and March, and we can't get the 50% to bring a suit after that.
LaPrade would like to see national agricultural interests coordinate trade deals that create a level playing field for all domestic producers.
We need to help each other. I can't say it any more than that. But don't put a guy out of business here just because you want, 10 cents more a pound on corn.
LaPrade and Carpenter are both apprehensive about food security and diminishing acres.
I've seen limes that used to be here be $100 a box. After this hurricane we just had back in the fall, avocados were devastated here. Mexican avocados were $100 a box. So I promise you, when the vegetable growers are gone in Florida, there will be no cheap produce coming out of Mexico.
With farmers on the edge of their seat ahead of another round of trilateral talks, some Floridians may be prepping for a final harvest. And while President Trump gets credit for calling attention to NAFTA's inconsistencies, it's unknown what sort of yield will sprout from the current political environment. For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
News from Capitol Hill and Beijing only added what was feeding market bears who have been speculating about next week's USDA reports. For the week, May wheat fell 8 cents and the nearby corn contract dropped a little more than a nickel. Private predictions for planted acres and the size of world supply were combined with trade threats to push the May soybean contract 21 cents lower. Meal went the other way, gaining $5 per ton. May cotton shrank $1.02 per hundredweight. Over in the dairy parlor, April Class 3 milk futures lost 7 cents. The livestock sector continued to take it on the chin as the June live cattle contract lost $5.55. Nearby feeders shed $3.65. And the May lean hog contract dropped $4.98. The U.S. dollar index plunged 75 ticks. April crude oil climbed $3.47 per barrel. COMEX gold bumped up $37.60 per ounce. And the Goldman Sachs Commodity Index gained more than 10 points to close at $454.75. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Hi, thanks, Delaney.
Naomi, we've gotten in quite a few questions this week on social media about the tariffs, and I want to start with a Twitter question. It's a little different than what we normally do, but we have Matt in Nebraska. His question is, on the trade tariffs with China, some say those will only hurt us short term as China needs beans and will get them somewhere, which will be us. Some say it will really hurt ag. In your opinion, which is it and how much?
That's a very important and timely question, of course, and top of mind for all producers and for the industry. My sentiment is that China, if they wanted to retaliate with a bigger punch, they could have done it this week when they were coming back with the amount of damage that they wanted to do to us. And they didn't do that. And so in my opinion, the short term is that China is going to be willing to negotiate here a little bit. You're going to see that because of soybeans, and exactly like the question posed, that marketplace, the demand is so strong, and we'll get into that in a little bit. But my view on this is that China's in it to win the end game. I think the bigger retaliations are going to be years down the road, but in the short term, I don't think that the news that we got this week is quite as scary as what some are thinking it could be.
Okay, and we'll get to that a little later in the discussion, and if not then in Market Plus.
Absolutely.
All right, let's transition here into wheat. We finally saw a little rain relief in the plains. Was that enough relief to make some prices hold?
Yeah, so what happened with the wheat market this past week has been a combination of technical selling by traders. Seasonally, the market starts to work lower this time of year, and the rain in the plains definitely was enough to make the market feel like, well, maybe that the wheat will have a chance to come out of dormancy all right. And so the market worked lower. I do feel strongly that the wheat is near a bottom of a price range for now. It's oversold technically. We've gone about, I think, as far as it's going to go. Now, we don't have any news to make that wheat market work higher. The global ending stock situation is just burying us, and the Russian wheat production numbers are just ginormous. So we're going to see the wheat market struggle probably for a good month or so. But one good thing to point out with wheat in the United States wheats is that our export market is on target for where we should be for export sales. And so that's really encouraging. But otherwise, yeah, the sell-off that we had is, I think, over, but we need some friendly newness now to get that market back up.
Definitely. Naomi, let's switch tracks here to corn. We've had a pretty outstanding pace when you look at corn exports, but some are worried we won't logistically be able to keep pace. Where do you look to see when we end up with corn exports? Where are you looking?
Yeah, so that's definitely something to be watching. We are on books scheduled to make it happen, but the reality is it going to get down the river in time to meet the end of the year numbers? And I don't know is the answer. Something to watch. I think it's possible. I really do. But that could be something that would be a surprise to the market if we can't make it happen. The bigger thing in the short term in in corn, is that we've got the planting intentions report right now for next week, Thursday, and the marketplace is expecting the number for acres to come in between 89 and 90 million acres. If we come in anywhere in between those levels, it's priced into the market. This little setback that we've had right now is normal. It's seasonal. It's okay. Prices are likely now going to trade sideways for a month. So that means a trading range. So looking at the May prices, maybe like the 370 to 380 price point, get ready for some boring trade, boring numbers for just a little while. But the bigger picture, corn is the friendliest commodity of all of these marketplaces right now because global ending stocks are coming down. Our ethanol numbers are going higher, and we've got production losses now in both Argentina and Brazil. So corn is going to be the friendliest thing. On these setbacks, if you needed to re-own anything, I would make sure you're doing that with some sort of a futures or an options strategy because the summer numbers have real potential for higher prices.
Okay. Naomi, let's transition here into the soybean markets. I know we touched a little bit on the tariffs earlier, but we've seen huge pullback towards the end of the week, really all across the week. Monday, we had a huge pullback. Where's today's lows because of President Trump's and China's retaliation against soybeans?
It was. The number that we went down to today on all of the contract months for soybeans was the 100-day moving average. And that was a technical target that would have been there regardless of this Trump information or not. That was the target anyway. Seasonally, beans work lower into the end of March. Sometimes that drawback continues into the middle of April. Same like with corn. I think that the soybean prices are going to stay softer here for a little while. Our demand is something to be watching. But when you think about China, and people are scared that, oh no, China's not going to buy beans from us. They are. They are. They need to. Right. Yeah. You know, 85% of what they use is imported. So their choice is us or Brazil. That's it.
Doesn't give them a lot of options.
Doesn't. No. So you're not going to see them do major retaliation. Could Brazil get a little bit more of our export business in the short term? Yeah. Absolutely, but it's also seasonally the time of year when they do because it's harvest down there.
And they've already been getting quite a bit of our business anyways.
Right. so a lot of that's priced in. Soybeans are going to have some support on some longer term uptrending prices. So $10 is the first big number for both old and new crop prices. $10 support should hold. If by chance it works a little lower, there's going to be even bigger support at $9.50. I don't want to write the soybean market off by any means. It still has potential. Absolutely.
Okay, that's good to know. And I guess when we look at other things impacting the soybean markets, how much are you still watching South American weather at this point?
Only watching it in terms of how it might affect harvest.
Okay.
The Brazil crop is, really almost done with harvesting, and the Argentina one is going to be coming up over the next 2 to 3 weeks. And then we'll know for sure what the damage was from the dry weather that they had. If the soybean yields in Argentina are worse than what people thought, then the market is going to find a real short-term low sooner than later. But otherwise, I'm looking more for sideways to a little bit lower for another week or two, but then we're going to hold support levels.
Okay. Naomi, let's move on to meat here. Cattle have had 5 sessions in a row where they were down. Today, the end of the week, we finished down again. Were Thursday's closes just a slight correction or an indication that we do have some upside potential moving forward?
The answer is twofold.
Okay.
So if you look at the charts and the futures trading, there is more technical downside that the markets can go, maybe $3 or $4 lower, and then the market will be technically oversold. We'll get a bounce from there. And then if you look separately at the cash market is telling us the truth.
It is.
It's the truth.
Okay.
That's, we got 126 cash. The futures discount is not appropriate. The futures price needs to eventually come higher, and demand has been fantastic. Domestic demand is great. We saw it in our cold storage numbers. Disappearance was there. Our exports are fantastic. So the futures market, yeah, it's going to get a little bit worse. And today's cattle on feed report didn't help anything. It was bearish numbers. So that's going to allow the marketplace to drop just a little bit on Monday. But I think that drop is going to need to be bought and re-owned, and the futures price is going to come back up, hopefully to more meet the cash market.
And I guess when you look at other things impacting the cattle markets, boxed beef cutout values have been relatively strong too. So does that also indicate to you that we should be picking up some pace here near term?
Yeah, those boxed beef values are the highest they've been since late June, I believe it was. So that just really shows how the domestic demand is strong, and especially as soon as all this snow melts, we're going to see people firing up those grills, and I think you're going to see just a big unexpected spurt of beef demand in April, and that's really going to help prices as well.
Definitely. What about when we look at feeder prices? Are you also bullish feeders long term?
It's going to have a little bit of a push lower.
Okay.
Earlier in the week, next week, just because technically speaking, it needs to. But then there's some long-term support at those levels, and we should see a rebound in prices. Big picture, there's a lot of cattle out there yet.
Yes.
And so supply is not the problem. We need to make sure demand stays strong, and as long as demand stays strong, we'll get a rebound in cattle prices, and then we'll start to trade more into like a sideways pattern. But I think a lot of people are needing to keep an eye on what's happening in the plains in terms of pasture conditions. That might be something that could be unexpected for summer if the pasture conditions don't improve. So the sell-off is coming, but there'll be a rebound higher.
Okay. Naomi, we're going to switch up the day today. We're going to talk dairy instead of hogs, but you can catch hogs on the Market Plus podcast, which can be found on iptv.org/MTOM. When we look at dairy, you're kind of our dairy expert, so to speak. We have a dairy question that we wanted to get, and I think it'll give a broad view here of what the dairy industry is doing. Matt in Whitewater, Wisconsin wants to know, is there any light in the tunnel in dairy? Is that light that's coming a train?
That's a good question. That dairy market's been beat up lately.
Yes.
We had the monthly milk production report come out earlier this week, and it showed, again, an increase in production. So we have a lot of milk supplies out there. The one thing that was good this week was that cheese prices have finally started to work higher, and so that lifted the milk price up. Here's the two-part answer. Front month milk contracts are not going to get a lot of love here in the short term. They're going to be stuck in the $14 range. But the deferred contracts, they have a light coming at the end of the tunnel because they're, technically speaking, starting to trend higher on the charts. And I think fundamentals are going to shift a little bit more towards friendlier. And I think the worst is behind us.
Okay.
But we have a lot of production out there. So any rallies are likely needing to just be hedging opportunities because it's just a lot of milk.
It is a lot of milk, especially when we look at what's going on in NAFTA and some of the other trade things. And we're going to get to some of that in the Market Plus segment. Naomi Blohm, thank you so much for being here.
Thanks, Delaney.
That wraps up the broadcast portion of Market to Market. You can catch more market information with Naomi on Market Plus via our podcast and video feeds on our website. And follow us on Twitter. Sometimes 280 characters is all you need to stay connected while putting seed in the ground. At Market to Market is here for news, photos, and links. Join us again next week when we'll assemble a panel of experts to examine the potential effects of the prospective plantings and quarterly grain stocks reports. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.